Hello, and I welcome you all in my today's lecture. Today's lecture is on some terminologies which are generally used in real estate valuation. So these come under the subject valuation of real estates, which has total 9 marks of weightage. So today we will see terms and phrases used in valuation of real estate. So first term is actual age. So the number of years that have elapsed since construction of property, it is also known as historical or chronological age. So I have also given a picture here. You can easily understand with the help of pictures that a building which was constructed in 2005 and today let's suppose in 2024 its age, its actual age is 19 years. So this age is called chronological age also. So please remember. Another term which we generally use is agents in production. So the land, labor, capital and entrepreneurship which create wealth, goods, services and income are called agents. So here is the picture depicting the same. Amortization. Amortization is a process by which a capital invested is recovered by a systematic schedule of repayments. So it is like EMI. Okay. So this is the picture which depicts the amortization. You can refer this picture. Another is amortization rate. So amortization rate is the ratio of periodic payment to the total capital. Okay, that is periodic payment is your monthly payment or yearly payment divided by total capital. Okay, so it is amortization rate. Another term, and this is the most important term, which is annuity. When we will learn methods of valuation, we will see annuity in detail. But for now, just remember the definition. An annual income, a program of or contract of regular payment of agreed amount. So it is the regular payment which we are getting as per our contract. So the picture says it all. So it is a annual payment, okay, which we are getting from our investment. Okay. So another is annual letting value or annual rateable value. So it is the rental value of the property assessed by the local authority for levy of property tax. So generally municipal corporation give the value for the tax calculation purpose. So municipal local authority adopting rental ways assesses rental value of all buildings within municipal limits for the purpose of levy of property tax. Rental value of the old buildings which have been assessed earlier are revised and reassessed periodically as per the provisions of the act. Okay, so the old building got revised. The annual rateable value of every property existing in different wards of local authority are recorded in the register maintained by each local authority. So every local authority do this. It is called annual rateable value or annual letting value. So please remember this. Another is appraisal. You all know what appraisal means. Let me repeat. Appraisal is a process of estimating value. It is an opinion of the nature, quality, monetary value or utility of specified interest in or with regard to aspects of identified assets. Okay, so valuer, what valuers do, they do appraisal of buildings, okay, or real estate. What appreciation means? Appreciation means an increment in value. It is easy. I just want to revise this term for you. Another is approaches to value. When we say approaches to value, we mean a process to estimate value of assets. For example, cost approach, for example, income approach, or market approach. So these are the approaches of value. Okay, these are not methods of value, these are approaches of valuation. Okay, please remember that. Okay, arm's length transaction. What is an arm's length transaction? This arm's length transaction terms come in the definition of market value. Okay, a transaction why parties unknown to each other who are under no duress to undertake the transaction. Okay, so this is the meaning of arm's length transaction, where the unknown parties do the transaction. Okay, which has no I mean to say no duress, matlab no, they are not enemy of each other. Before tax cash flow, this is about another term. So income remaining from operating income after the payment of debt service, but before payment of income tax. Okay, so this is called before tax. So this is the picture which depicts the condition. So gross rental income less operating expenses equals net operating income less debt services, any debt which you have taken, so you will repay that. This will give you a cash flow before tax, or tax before tax cash flow. Okay, another is benefit cost ratio. So the benefit cost ratio is the ratio indicating present value of future benefits of an investment to the expenditure incurred for creating the asset in its existing state. Okay, so it is the present value of future benefits. Okay, note it, present value of future benefits of an investment to keep expenditure incurred for creating the asset in its existing state. The benefit cost ratio is a financial measure used to evaluate the economic feasibility of a project by comparing its total expenditure, total expected benefits with its total cost. Okay, it shows how much benefit is obtained for every unit of cost incurred. In simple terms, we can understand if benefit cost ratio is greater than 1, project is economically viable. If benefit cost ratio comes equal 1, it means benefits just equal cost, and if benefit cost ratio is less than 1, project is not viable. We will not undertake this project if BCR is less than 1. So I tried to depict that in a picture. Please take a moment and see the picture. I hope this will clear this example as well. Okay, another is book cost or book value. The cost of acquisition of an asset indicated in the company's ledger, inclusive of all taxes, erection, installation, foundation, pre-operative expenses, and other related costs, sometimes referred to as gross book or gross block. That is original cost before deduction of depreciation. Okay, this is book cost. Okay, purchase price plus stamp duty plus property taxes, other related cost. Okay, and then these costs also. So this gives the book cost. Okay, this shows in the company's ledger. I tried to make the presentation very engaging by these pictures only, because this is not a live presentation, so I cannot ask you something, or I cannot ask you to I ask you to doubts. That's why I tried to keep a picture with the definition, so it will be very easy for you to understand these terms. Book depreciation, another term, which means depreciation provided in the books of account as per policy of the company. It is the amount written off on capital accounts regularly during ownership of an asset. Okay, this is the depreciation which is written in the books. So in the picture itself, you can understand the initial cost is 10 lakh. Year 1, year 2 it got depreciated by like 15,000 rupees, where another year it got depreciated, for another year it got depreciated to 20 years. After depreciation, the book value is 0, because the accumulated depreciation, which is the total of the depreciation in this 20 years, so it is comes out to be 10 lakh and the book value is 0. Okay, it reflects the wear and tear and obsolescence and due to the ownership of the property or asset. Okay, another term is book value. So it is the original cost of an asset after providing the depreciation for the period of use uh, as per the policy adopted by the company by straight line method or diminishing balance method or any other method. So these are the method of depreciation. Do not go in depth for these, just look at the names for now. So I was saying that it is the original cost of an asset after providing the depreciation for the period of use by any method of depreciation as shown in the books of account of the owner of the asset. So this value is after depreciation. It is account method of indicating value of asset after deducting depreciation in the books of account. Okay, so what we are doing here, we are taking the value of asset without depreciation, and then we are deducting depreciation. Depreciation can be calculated by any of the method which are available for the depreciation, and the net value which we got after deducting depreciation, we got the book value. Okay, in case of asset which is in use even after claiming 100% depreciation, they are shown generally with a book value of rupees 1. Okay, so if anyone who can want to understand this concept also can read this last line. So this is about book value. Another term which is used generally is break even point. So this is the label of operation of an enterprise at which gross income equals to the sum of expenses incurred to keep the concern going. Okay, this is the very important definition, I must say. When I was a student, this question was asked in the examination itself. So please remember, this is the favorite term of examiner. This come very frequently. So we will study it again. The label of operation of an enterprise at which gross income equal to the sum of expenses incurred to keep the concern going. Okay, so this is the break even point. Here you can relate with this picture, like rental income, sales revenue, the revenue which we are getting from any property or any asset got equal to the expenses. We are not in profit or not in loss, we are just zero. Income becomes equal to the expenses, so we got nothing. but this point is called a break even point. Okay, so you can remember the break even point by this picture only. Another is bundle of rights in an asset. So this is generally used in the legal terms, like I should say in agreement or anything. So what it says, the concept of comparing asset ownership to a bundle of sticks, with each stick indicating a distinct right of the asset owner. For example, a right to use, right to sell, to give it on lease and license, or live and license, to lease out, to mortgage, or to choose to exercise none of these rights, or to exclude all the rights. The loss of any one of these rights could alter the value. Okay, so if a person is the owner of any property or any asset, it includes all these rights generally, if it is not excluded by any means. So we generally say ownership, but it is not only ownership, it is bundle of rights itself. So it covers very large number of rights, like example, for to buy, to sell, or to live, to give lease. Okay, so these are the example of the rights, but it comes under bundle of rights. Okay, so in this picture depicts the same. You can understand by this picture. A breakup point. Okay, so when any running unit or an enterprise is closed down, okay, now it is not a running concern, or we can say we have closed down the factory, or any mill, or any like enterprise we have closed, and sale of each individual asset is investigated or planned separately, it is termed as breakup value of the property. So we are selling each asset individually, like if a company has a home, or we can say guest house, or the company building, or a factory, then if it is going concern, then we can sell as it is. But if it is closed down, sometimes we have to sell them separately. So breakup value talks about that, like we are selling everything separately. So we are selling house for 20 lakh, we are selling this factory building for 80 lakh, or we are selling any office for 10 lakh. So total value comes out by adding these. Value of each asset is estimated separately in the isolation of other assets. Building may be sold separately in the different parts, as I told you. So this is breakup value, please remember. So for today, that was all from my side. I hope these terms are clear to you, and I try to keep them very engaging. Thank you.